Hello, friends. Thanks for joining me on this session. Uh, you must have observed the Chapter 8 lecture. There are a couple of things which I left out deliberately so that you have time to absorb whatever has been done in the earlier part. So, the first thing which I would like to touch is how to provide depreciation for the partial year. Partial year means that normally we assume that we have acquired the asset on January 1st, and then we calculate the depreciation for the entire year. What happens if you have acquired the asset, let us say on April 1st or July 1st or October 1st or any other day? So in that case, to provide the depreciation for the entire year would be unfair, incorrect. So good thing may be to count the complete months and provide the depreciation only for those months. So I thought that let us look at an example. Suppose you acquired the asset on July 1st, 2018, and the cost of the asset is $68,000. Its estimated life is 10 years, and its residual value is 3,000. And we are assuming it will be subject to straight line depreciation. So normally you calculate what 68,000 minus residual value of 3,000, total depreciation 65,000, the life of the asset is 10 years. That means every year the depreciation is 6,500, 6,500. But in this year, because you have purchased the asset on July 1st, you should be providing depreciation only for half the year. That is July, August, September, October, November, December. So the amount of depreciation would be 65,000 divided by 2. That is for half year, $3,250. And the entry for depreciation would be depreciation expense debit, $3,250. Accumulated depreciation, 3,250. Now onward, till the asset is with you, you'll be writing up depreciation 6,500, 6,500, 6,500 every year. Now, second thing, I did talk about the declining balance, but majority of questions, virtually all of the questions, talk about double declining balance method. Now, what is a double declining balance method? Whatever is the rate of simple declining method, you double it up. For example, let me revisit declining balance method. You purchased an asset for $100,000. The salvage value is $5,000. So you might feel that you will be depreciating $95,000, but no. In declining balance method, you do not subtract salvage value. And the life of the asset is 10 years. So what do? You take 100 divided by 10. That means every year you should be writing off 10%, 10% depreciation. But 10% of the balance in the asset account. So first year, the value of your asset is 100,000. 10% is $10,000. So first year depreciation would be 10,000. Second year, now the value of the asset is 90,000 after you've taken the depreciation. And now you provide 10% of 90,000. That will be 9,000. Now in the third year in the beginning, what is the value of the asset? 81,000. So you'll be providing 10% of 81,000. That is $8,100 as the declining balance. But in double declining, because we are using 10%, we will make it 20%. That means in the first year, on 100,000, you're providing $20,000 depreciation. In the second year, now the written down value, declining balance is 80,000. You'll be providing 20% of 80,000, that is $16,000. In the third year, now the value of the asset is 64,000. You're providing 20% of this, that is $12,800. So that is the way you'll be providing depreciation. Now, what happens? You are to write off depreciation as per double declining balance, and you have purchased the asset in between the year. Let us say you have purchased the asset on October 1st. So take the same question. 100,000 is the value of the asset. Salvage value ignore in double declining balance method. As we ignore in declining balance method, life of the asset is 10 years. So the depreciation every year would be 10%. And it is double declining, that means we'll be providing 20%. So the first year depreciation should be $20,000. But because you have purchased the asset on October 1st, right? That means the depreciation in the first year would be $5,000, 1/4 of 20,000, right? And then the remaining 15,000 we were writing next year. That is the story of double declining balance method. Now, the next thing is knew in the beginning only the actual cost of the asset. Two things we try to estimate. The way we estimate it, what is the expected life, 10 years, and what is the estimated residual value, whatever is the amount, in case of a straight line method. What happens after some time, you pick up that you made a mistake. The life of the asset may not be 10 years, it may be 12 years or 8 years. And you feel that the residual value may not be 5,000, it may be 10,000 or 3,000. How to correct it? So the time you decide that you need to make a correction, so you take what is the value of the asset at that point in time. Okay? So suppose the value of the asset at that time is $60,000. And you felt that the remainder life was 6 years, you feel no, it is wrong. It is not 6 years, it should be 5 years. And residual value of the asset is not whatever amount you think residual value is, 5,000. So what you will do, you say $60,000 minus residual value 5,000. That means 55,000 is to be depreciated. And how much is the life? 5 years. That means every year it should be 11,000, 11,000, 11,000. So now onward, from this point onward, you will be writing off depreciation at the rate of 11,000. The entry would be depreciation expense debit, accrued depreciation 11. You keep doing that thing without problem. Now, the last thing about chapter 8. Why do we emphasize or take that much interest in depreciation? According to the accounting rules, according to the tax rules, depreciation is treated as an expense. This is the spread of the value of the asset over its productive life. So whatever comes the share of every year, we say it is an expense. But this is a peculiar expense. Unlike other expense, you pay salary, you make the entry salary account debit, cash account credit. You pay for electricity, you say electricity expense debit, cash account credit. You pay for rent, you say rent expense debit, cash account credit. So everywhere cash is going out. But in case of depreciation, we do not pay cash to anyone. It is just an entry, depreciation expense, and credit thing we put in the accumulated depreciation account. Now, because of treating depreciation as an expense, what happens to our income? To that extent, amount of depreciation expense, our asset has gone down. Our asset has gone down in value, and that amount is treated as an expense. That means our total expense has gone up, and because of that, our income has gone down. Because our income has gone down, that means we'll be paying less tax than what you should have paid if there was no depreciation. So the tax we are saving is called tax saving, or we call it tax shield because of depreciation. So depreciation attraction is that you don't spend any money. It is not a cash item. You don't spend any money, but the amount of depreciation is treated as an expense. And because of that, you save your taxation. So every business, big or small, would like to take interest in depreciation. Bigger the depreciation, bigger the tax shield. So everywhere people want to have depreciation. In some systems, in some countries, they try to give you permission to claim bigger amount of depreciation so that you can get a bigger chunk of tax shield. Many governments have used this technique of playing with the depreciation amount and percentage because they want you to modernize or computerize or replace your asset faster. So they say, okay, for so many years, you can increase the amount of depreciation. When you write more depreciation, you get bigger tax shields. So governments can get the modernization of industry and plant and machinery, and you also save money because that is a temptation. So this is the topic of long-term asset, and we have talked about depreciation. My request and suggestion to all of you is that whenever you are doing a chapter like 7 or 8, try to do 5 or 6 quick study problem at the end of the chapter. Try to do some exercises so that you will get the practice. As I told you, and I have already put long back, the sample test number 3. So after doing these 2 chapters, you can start talking about chapter sample test number 3. Try to do them. If there's a problem, try to send me an email. When I access my computer, I will try to answer it. I know it is a difficult thing, but you do that type of thing. It should be quite easy for you. Okay. Now we will talk about chapter 9. Chapter 9 talks about reporting and analyzing current liabilities. So let me start with what is the liability? Liability is our obligation, expectation from us, what people are expecting from us. So obligation is some sort of a due from us. We should be paying to some other person a particular amount. Now, if the amount is payable within a period of 12 months, we call it short-term liability or we call it current liability. If the amount is paid after 12 months, we call it non-current liability or long-term liability. So in this chapter, we are talking only about current liability, that is short-term liability. Now, how do we have short-term liability? Short-term liability may arise when we buy something on credit, like merchandise inventory debit, account payable. Account payable is a liability. Invariably, whenever you buy merchandise on credit, the credit period is usually 45 days or 2 months or 3 months. That means it is a current liability you need to pay. And when you need to pay, the entry would be account payable debit, cash credit, you have paid the liability. Okay. Other ways to create the current liability is for expenses. You have lived in a premises, you have not paid the rent. Now, you are supposed to pay it. So you will make the entry, rent expense debit, rent expense payable. Liability is always payable. It is a liability. Another way, your workers have worked for you, you have not yet paid them the salary, you should pay them the salary, so you create a liability. How do you create the liability? Salary expense debit, salary expense payable, liability. Same thing, you have received the bill of electricity, you have not yet paid, so you need to create a liability. Electricity expense debit, electricity expense payable. Payable, due, outstanding. These are the abbreviations or synonym for liability. Another thing, when you are selling things, You sell a thing for $100. Normally, in all the city jurisdictions, you are supposed to charge tax also. Who pays the tax? Actually, the customer. But you collect from the customer because sales tax people don't have the manpower to go to the customers to collect the sales tax. So when you are selling a thing, you are to charge from the buyer the sales tax. So you sold a thing for $100, and let us say the sales tax is $5. So customer would be paying you $105. So the entry would be cash account debit, $105, sale tax payable, $5, sale revenue, $100. This $5 which we have collected, which we have put in the sale tax payable, it is customer's money, but you have collected for the government, for the city jurisdiction. So after some time, maybe 3 months, you'll be paying the sale tax, total amount collected, to the sale tax department. And you will make the entry sale tax payable debit because now you are paying cash account. So that is the way you treat short-term liability of the sale tax. Other thing is when you buy something or you borrow some money and you say, I will pay after 3 months or I will pay after 6 months, short term. So we call it short term note payable. Short term means less than 1 year. So you borrowed the money, let us say $5,000 for 3 months. You will make the entry when you borrowed the money, cash account debit, short term notes payable, credit. It is a liability. After 3 months or 6 months, when you pay the thing, you will say sale tax note payable, short term note payable, debit, cash account, credit. You have paid the money. At time when you are making the payment on the short term note payable, you may also pay the interest. Normally, the amount would be given to you, and the entry would be like when you borrowed the money, short term note would be payable would be credited, cash would be debited. So suppose you borrowed 10,000, so cash account debit 10,000, short term note payable 10,000. Now suppose you have to pay after 3 months and the rate of interest is $100 and you are paying it now, you will say short term note payable $10,000, interest expense $100, cash account $10,100. You have taken care of your liability. Another is short-term liability is created when you have received the revenue, but you have not yet done the work. You remember we did this thing in chapter 3, and there was a question also on test number 1. We call this liability unearned revenue. It is revenue received in advance liability. So when we received the revenue, like Gone with the Wind, we collected $3,500 as revenue, but we have not yet shown the movie. What entry do you make when we collect the money? Cash account debit, 3,500, unearned revenue, credit. Unearned revenue, credit, so it is a liability, 3,500. So till you do your part, this unearned revenue will appear on the liability side, and it is your liability. Normally, there are 3 things which are expected in the liability. In a general case, first thing is you must have done something in the past. For example, you purchase the merchandise. That create a present obligation that you have to pay it. And it is a future liability, future payment that after 3 months or 45 days or 4 months, you will pay the money. When you pay the money, like account payable debit, cash account credit. If any of these 3 things are not given there, that means you will have doubt about recording it. Okay? Another thing in the liability, something can be unknown to you. When to pay, whom to pay, how much to pay. These are some sort of hints for you. And as I told you earlier, requested you, please do read the chapter. Do read the PowerPoint slides. And whatever I am telling you, repeat, look at it again and again. Now, another thing, these were our known liabilities. Now we go to the next one. We say payroll liabilities. There are two types of things. Suppose I have hired 5 people in my business. I'm supposed to pay salaries to them. Suppose their salary is $2,000 every month. In a very good old days, 5 people, $2,000 every month. I will say salary expense debit, 2,000 times 5, $10,000 cash, $10,000. Very good. But nowadays, in all the countries, there is an obligation on the employer, which I am. I'm expected that when I pay the money to my employees, I should deduct something from their salary by way of federal tax. I should deduct some money from their salary by way of state income tax. I should deduct some money from their salary for FICA, Social Security. I should also deduct some money for the Social Security, Medicare, Medicaid. If there is some other thing like union dues, if the employee is member of some association. So when I give him the salary from $2,000, I'll be deducting some federal tax, I'll be deducting some state tax, I'll be deducting some FICA, I'll be deducting some union dues, and whatever is remaining, I will pay the money to the employee. So what entry typically I will make? Salary expense debit, FICA tax payable, state tax payable, federal tax payable, Medicare payable, union dues, and whatever is remaining, I will say salary payable. And in the next entry, I will make the entry salary payable, cash, credit. I paid the money. Now, this money I have withheld from the employee's salary, which after some time, monthly or quarterly, I will send to the FICA people, Social Security people, Medicare people, federal tax people, state tax people, union people. Not only this, as I pay on behalf of the employee, then employees also pay for FICA from their salary. Right? Employee also pay, I have also paid, they also pay, and this is called payroll taxes for them. Okay, so remember that. I pay payroll expenses on behalf of employees. Employees pay payroll taxes from their salary. And like their unemployment insurance, federal level, state level, etc., etc. Do read things in the chapter, they are very clearly given. Another thing is estimated liability. Estimated liability means that you may give a promise to the employees that we will pay for your health insurance. So whatever you are paying for the health insurance, you treat this thing as an expense and you take that money and put in the health insurance. Like health expense debit, health insurance. So the money is collected when employee need it, they can claim from the health insurance. Like this, vacation also. At times you may promise to your employees that after every 200 days, 100 days, 300 days, we will give you, let us say, 2 weeks vacation period free. So what do? You set aside some money, vacation expense debit, and you put vacation liability. You keep on doing, and after the stipulated period, when the employees go on vacation, they submit the bill and you take out from this vacation period liability and give the money to the employee. Same way when you are selling to the customers some product, in order to boost up your sale, right? You may promise to the buyer that if something gets broken, right, we will take care of it. You give them promise. They will not be charged. We call this thing in our commercial language warranties. So suppose you have sold something like mixers or the cookers or microwave oven, and you say, okay, we will pay. On your experience, normally $50 may be expected thing. So you may created a warranty expense for each microwave sold. So you will say warranty expense debit, $50 per microwave, warranty expense liability, $50 per thing. Next year, next to next year, if there is a chance, they will put their bill and you will take the money from warranty liability. So you will debit the warranty liability and whatever is the expense, you will pay from there. So remember this type of thing. Another thing which is very interesting, that at times there may be some sort of uncertainty element. For example, the common thing is you are sure a liability would be there, but how much may be there, you are not sure. So you will create some sort of a contingent liability. You know that liability is there, but how much is there, we don't know, so we call it contingent liability. Now, if you don't know what may be the amount, or you also don't know whether there may be a likelihood of you're paying something, then you may just write some sort of a thing in the disclosure notes after financial statement, and that should be good enough, and we just call it contingencies. Any other thing, we need not worry about this. Another thing I thought, let me talk to you about, and that is when you borrow money from someone, we normally expect that the money is borrowed and paid in the same year. But what happens if the money is not paid in the same year and you are paying interest? That may be some sort of a problem. Let me give you an example. Let us say you borrowed $10,000 for 6 months. Okay? And the interest of 6 months would be $120. Okay? So when you borrowed the money on October 1st, one entry you would have made cash account debit, short-term note payable, $10,000. You have created a liability. Now, your year ends on December 31st. But the period for the note will end after 6 months, and after 6 months would be 31st March next year. That means when you are preparing the accounts for this year, that is after 3 months, on 31st December, how much interest you have accrued, you owed to the person who has given you the money. Half of 6 months is $60. That means $60 interest you will not be paying now, but you are under obligation to pay it whenever you are making the final payment. So what entry will you make in the month of December on the date 31st? Interest expense debit, $60. Interest expense payable. You are supposed to pay it at the end of March, $60. At the end of March, when you are making the payment, how much money you will pay? $10,120. What would be the entry? You will make the entry short-term note payable, $10,000. Interest expense payable, $60. This is from the last year. Then interest to be, no, let me repeat the entry again. You'll be making the payment entry, ignore this entry. Short-term loan payable, $10,000. Interest expense payable, $60 of last year. Interest expense, 3 months of this year, $60. And you will make the payment cash account credit. How much? $10,120. Thank you very, very much. You Do this, and whatever are the examples I've given you and suggested you to do in the sample test, try to do that thing. It will be a very, very good item. I'll be very happy. Thank you for listening to whatever I've spoken. Thank you. I will encourage you to read these 3 chapters. These 3 chapters are the subject matter of test number 3. Pretty soon I will put chapter 10, 11, and 12. My request, do as much reading, as much practice as possible. Thank you very much.